Hello everyone, and thank you for taking the time to view my presentation. Today I'm going to be talking about overcoming the double title to property problem in fractional reserve banking. So fractional reserve banking is the form of banking which we are most familiar with today. When we deposit money into the bank takes some proportion of the money and lends it out to others who borrow the money at a specified interest rate. In turn, the bank pays the depositor interest on their deposits. In this way, the bank acts as a credit intermediary between depositors and the borrower. The depositor can lend out their money to others without the work of searching for a borrower and negotiating a rate or bearing the risk of non-repayment from that borrower, although they still incur the risk of non-repayment from the bank. The amount of money that is held on hand by the bank relative to how much money they have lent out is known as a reserve ratio. For example, with a reserve ratio of 10%, for every $100 deposited, $90 is lent out and $10 is held by the bank. Fractional reserve banking can be contrasted with 100% reserve banking. In this case, the bank keeps all of the deposited money on hand. The bank also refrains from the creation of deposit certificates in excess of the amount of money held by the bank, which means that all deposit certificates would be held by depositors or by those whom the depositor has exchanged them with. So if a bank held $1 million in their reserves, this would mean that exactly $1 million in deposit certificates would be held by the public and no more. So what are deposit certificates? When the depositors deposit money with a bank, they are given what is known as a deposit certificate. These certificates give the holder the right to demand some specified amount of money from the bank at any time. Deposit certificates can take on multiple forms. Early paper money in Europe, for example, began as paper deposit certificates which depositors could use to demand gold deposited with banks or with goldsmiths. When a depositor would deposit 20 ounces of gold with a bank, they would be given a deposit certificate which they could use to claim 20 ounces from that bank when they chose. These certificates could be and historically were exchanged between private citizens, meaning that those who held the deposit certificates could demand money from the bank at any time, even if they themselves were not the original depositors of the gold. Today, deposit certificates take on numerous forms. One widely known example is that of the checking account. Depositors are able to exchange certificates to the right to claim money deposited by swiping their debit card, or they can actually ask for deposited money by using an ATM, exchanging their deposit certificates, which in this case is just an amount of available funds on a digital checking account, for actual money which they gain at that ATM. The particular criticism of fractional reserve banking that this project attempts to dissolve is that fractional reserve banking creates two titles to the same piece of property. By this, I mean that when banks lend out deposit money to borrowers, it appears that both the depositor and the borrower have title to the same piece of property, namely the money deposited. For example, suppose that Jones deposits $100 in the bank, and that bank subsequently lends out 90 of those dollars to Smith. Now, Smith believes that he owns the $90 which he has borrowed, and Jones believes that he owns the entirety of the $100 which he deposited. There's therefore $90 which two people believe they have title to. This is a problem because it creates a conflict of rights in that both parties believe that they have the right to use the money in the way they choose, including in ways which might conflict with one another. Jones believes that he has the right to spend the money on a new car, while Smith believes that he has the right to spend the money on a new laptop. This is what is known as a double title to property problem. In 2007, Lawrence White sought to overcome this problem by claiming that the common checking account is, at least to all appearances, a type of callable loan where the lender is the account holder and the borrower is the bank. So what is the call loan? The call loan separates itself from the ordinary loan in the following way. While there may be a specified maturity date, the lender is able to ask for the principal to be transferred to him at any time. The following is an example. On January 1st, 2021, Joan lends $100 to Smith for 1 year at a rate of 10%. Since this is a call loan, Jones retains the right to demand the amount of money lent at any time. That is, the $100, have it transferred back to him. On July 1st, 2021, Jones calls the loan and has the $100 transferred to him immediately. As long as Smith does deliver the $100 to Jones on July 1st, 2021, the terms of the deal are fulfilled. While there is room for variation, when conceptualized as a call loan, the checking account takes the following general form. The depositor lends some amount of money, the principal, to the bank. The instant that this contract is initiated, unrestricted title to the principal is transferred from the depositor to the bank. Interest may be earned on the money lent and is compounded at standard periodic intervals. Interest earned is added to the principal as it compounds. The principal plus interest earned is the balance. Title to the balance remains with the bank. Title to any portion of the balance is transferred from the bank to the depositor upon the depositor demanding it or calling the loan. Okay. Now, there are three ways in which double title to property can appear to emerge in a fractional reserve banking system. The banker can take the money for himself, The banker can lend out deposited money directly to borrowers, or the banker can create deposit certificates in excess of the amount of money held on reserve. So in the first case, the banker can simply take the money and live it up, spending it however he pleases. In this case, it appears that both the depositor and the banker have title to the money. The depositor thinks that the right to spend the money is with him, and the banker thinks the same thing. However, when conceptualized as a call loan, no such double title arises when the banker spends the money. Rather, when the call loan is initiated, the banker gains title to the money and thus has the right to spend money how he sees fit. The depositor has no right over the use of the money at all until he calls the loan. Suppose that a depositor deposits $100 in the bank, and the banker takes this money and turns around and spends the deposited money on groceries. Since title to the money is held exclusively by the banker at this point, as the depositor has not yet demanded their money back, this is a completely legitimate use of the money. The loan only becomes due upon the depositor calling the loan or demanding some amount of their balance back. In this case, there was no time in which there were two titles to the $100. The second way in which double title to property could occur is if money held by banks is lent out directly to borrowers. Again, it appears that title to money deposited belongs to two people at the same time, but instead of the depositor and the banker each having title, it is the depositor and the borrower who appear to have conflicting rights. Once again, when bank deposits are conceptualized as call loans, no such double title to property arises. Suppose again that a depositor deposits $100 in the bank. This time, however, the banker does not take the money to spend on his own consumption. Instead, he lends out the money to a borrower at an interest rate. What has occurred here with regards to title to the money originally deposited? The beginning of the story is the same as previously. When the depositor deposited their money, they transferred title of that money to the bank. As we have already seen, the banker then has the right to do with this money as he pleases. This includes lending the money out. When the banker lends out the money to the borrower, title to that $100 is transferred from the banker to the borrower. Now, the borrower has the right to use the money how he pleases since he has title to the money, not the banker. In this case, there are not two titles to the money, but one. Title to the original $100 was deposited and is now held exclusively by the borrower. This is because when the depositor deposited his money in the bank, he gave up title to that $100. The banker here also gave up title to that $100 when he lent the money out to the borrower. He transferred title to that $100 knowing that he would earn an interest from the borrower. At this point, there are no title claims on the money beyond that of the borrower. Thus, no double title to property arises. The final way in which double title to property can occur through fractional reserve banking is by the creation of deposit certificates in excess of the amount of money actually held by the bank. In this case, the banker creates deposit certificates which he sells to borrowers in exchange for interest. In this case, it appears that all holders of deposit certificates have title to the money held in reserve. This is a problem since there will be more titles than there is physical money to have title to, creating a conflict of rights. Suppose that a bank holds $1 million of money, which comes from exactly $1 million of deposits from depositors. This means that the bank has issued $1 million in deposit certificates to those depositors. Suppose that the bank now decides to create $100,000 in new deposit certificates, letting them out to borrowers at some rate of interest. If everyone holding a deposit certificate believes that they have title to that amount of money, there now exists $1,100,000 worth of titles to the money when only $1 million actually exists in the bank. At this point, it appears that $100,000 of money in the bank has two title holders instead of one, and once again, a double title to property presents itself. However, when viewed as a system of call loans, once again, this is practice of fractional reserve banking creates no double title to property. In this scenario, the beginning of the story is the same. The depositor deposits $100 in the bank. Again, title to that $100 is transferred from the depositor to the banker. This means that the banker has the right to use the money how he sees fit. This time, instead of lending out the money directly to the borrower, the banker creates a different form of contract. In this case, the banker creates more deposit certificates that are to be held not by depositors, but by borrowers. He lends these deposit certificates out in exchange for interest from the borrower. Who holds the title to the original $100 deposited? In the call loan view of the bank deposit, deposit certificates do not represent title to money held in the bank. Rather, they give the holder of the deposit certificate the right to demand the equivalent amount of money held by the bank as is stated by the deposit certificate. This is true whether deposit certificates are held by depositors or by borrowers. Since deposit certificates do not represent title to property held in the bank, neither the depositor nor the borrower can be said to have title to the money in the bank, as both of them only hold deposit certificates. In this case, the banker has title to the $100, which was transferred to him upon the initiation of the original deposit contract, and once again, no double title to property emerges. Thank you so much for listening to my presentation, and I very much look forward to your questions.